Straza, what's up?
What you doing?
I'm shooting a live stream with Sean.
We're live now, Straza. You're it up.
Totally it up. Hey guys, JC Peretz here, founder of AllStarCharts.com, and I am joined by my esteemed colleague, Mr. Sean McLaughlin. Let's give it up for him, y'all. Give it up for him.
What's happening, buddy? Glad to be back in the office. I mean, I'm not that glad to be back in the office. Had a great little trip, but it's good to be working hard again.
So while you were gallivanting around Northern California, some of us were here working. But you have an interesting little tidbit. You were doing some hiking in Northern California. I want you to tell the folks. And when you were waking up, you know, the market was opening before you went on your hikes, and you were able to enter some positions, one of which is long a uranium stock, the uranium stock, as far as I'm concerned, CCJ. Walk us through what you did before your big walk.
Yeah, well, you know, the nice thing about being on the West Coast is the market opens at 6:30, but the sun doesn't come up until 7:15, at least this time of year where I was. So I was able to get a little work in every day, early part of the day. And, you know, like I always do, I was catching up on all the research that the team here puts out. And you, particularly you, have written a blog post this week about zooming out to kind of take in the big picture when considering putting on trades. And in that blog post, one particular name you highlighted was this Cameco CCJ. And boy, I looked at it and I'm like, yeah, I got some time to put this trade on before I hit the trails. And so we put the trade on yesterday morning. And but, you know, more to the point, I mean, let's talk about the setup that we have here before we get into the options details. I mean, you've got a chart here showing, I don't know, about a 10-year period here. And we're just now finally starting to poke our heads decisively above an area that's been resistance for 10 plus years. And based on what you see, you think we got some good room to run here over the next few months up into the 40s, yeah?
I mean, listen, the market has proven that there's an overwhelming amount of supply relative to demand at these prices, or at least there has been. So when prices are able to surpass those former levels, that's the market signaling to us that demand, finally, after 10 years, has been able to absorb that overhead supply. It's been a 10-year digestion period. So once we're able to surpass that like we did, I mean, oftentimes it really has a lot more room to run before we get to that next level where historically the market has proven that there's more supply than demand, which happens to be up in the mid 40s, which were those 2011 highs. And you can see there, actually, I'll highlight it right here with the mouse, right up here. That is when the old earthquake in Japan and Fukushima nuclear meltdown was a complete disaster. I remember vividly because I was long both uranium and the uranium ETF. And I got smoked because of the tsunami and the uranium breakdown. And I did not manage risk as responsibly as I should have. This was over a decade ago. It was the worst trade I ever put on in my entire life. It was a great lesson. And just staring at this gap here, you know, brings back terrible memories that I never want to relive ever, Sean. And I will make it my life goal to never experience that again. And I haven't since, and I don't plan on doing it now. So if we're back below 26, we're not above that, I don't want any part of this thing. We only want to be long if we're above 26, uranium or otherwise. But this one brings back those memories.
Well, sorry that you're experiencing a little PTSD there. But hey, look, maybe we can make up for it here. This stock is breaking above a 10-year resistance. And I don't know about you, JC, but when a stock breaks a 10-year resistance, it tends to happen quickly and maybe faster than many people are prepared for or expecting.
Chevron.
Now, I'm not expecting Cameco to make a run to that 44 level next week or even next month. But we put an options trade on that gives us until September for this stock to really start threatening to make a move. And we don't even need it to get all the way there for us to hit the profit target that we're looking for. The trade that we put on is I bought September options. I bought a bull call spread. I bought the 30 strike calls and I sold the 40 strike calls against it because there was some nice premium at that option. And I paid $220 all in. Now, look, yesterday and today, Cameco has had a pretty good run. So if we weren't in it right now, I wouldn't want to be chasing it right here. I would be patient. I would wait for it to come back a little bit. I'd be cool paying up to 230, maybe 240 for the spread, but I don't think I'd want to go beyond that. I still think the trade is valid at those prices, but don't chase it. We got time. We have till September. But man, if Cameco makes any kind of threat at running towards that 44 level, we will have plenty of opportunity to hit our profit target. Now, we're not trying to maximize the value of the spread. The most the spread could be worth is $10, right? Because we're long the 30 strike, short the 40 strike. That's a $10 difference. The most that spread could be worth is 10. I'm not looking to sell the spread for $10. I'm looking to get out when I could get out for about 620, 610, because for me, that would be representing capturing half of the maximum potential profit in the trade. There you go. You got the little graph up there. I'm just looking to take the half. I don't want to hold this trade all the way to September if I don't have to, JC, because look, let's fast forward to let's say it's middle of August and Cameco is working really well. The stock's trading up around $40 and our spread that the most it could be worth is 10. Let's say now it's trading at 9. And I'm like, great, this is a great trade. Well, at that point, I'm holding the spread. I can only make $1 more, but I'm holding $9 in risk, right? If the spread's worth $9, if the thing were to turn around on me, I'm risking $9 to make $1. That's why I don't like holding these spreads all the way to expiration and trying to squeeze out every last nickel. I just want to get out when I could take half of the maximum profit, move on to the next trade. That's a best practice that I do all the time with bull call spreads.
So let's just reiterate. This is a CCJ Cameco September 30-40 bull call spread, approximately a 220 debit when you put it on yesterday. This means that we are long the 30 calls and short an equal amount of the 40 calls for a net debit, which of course represents the most that we could lose. These are the September expiration.
I couldn't have said it better, my friend.
Well, I was literally reading your text word for word. So you actually did say it. But any other thoughts on risk management? Any other layers to add on top of that?
Yeah, so we do have a risk management level that we're watching. If the stock comes down to $26, if we close below 26, that's my line in the sand. That's where I'm going to take the trade off because, at least as far as I'm concerned, my thesis is wrong, even if it's only temporarily wrong. It's wrong right now, and I'll want to get out and minimize, the risk of any further losses. But since you brought that up, when I put the trade on, when I paid $220 for the debit, I always size that position with the assumption that if I'm wrong, I'm going to lose everything. Now, I don't always lose everything in those trades. In fact, I rarely will lose everything. But in the worst case scenario, if I'm dead wrong, the most I could lose is the debit I pay up front. So I make sure to size my position in such a way that if I take that full loss, it's nothing but a, little nick on my overall portfolio. And that's the way smart traders do it. That's what keeps you in the game. You never want to have a trade on that can take you out of the game. That's bad news.
No matter how beautiful the base is.
That's right. That's right.
It's a nice base. And what's interesting about the uranium is that you got your uranium crazies. You know how certain asset classes have their crazies, like Tesla crazies, and you got your gold bugs. And then back in the day, you had your Apple crazies, and then, you got your natural gas crazies too, but you got your uranium crazies. Big community in Canada who hypes up uranium quite a bit. So you got a cohort that can really blast this back up towards those
crazies. And you got the global environment that's going on right now that's just adds fuel to the fire. So yeah, I mean, this thing, we're not, like I said, we're not making the bet that it's going to scream higher next week or next month, but it could happen. It definitely could happen.
Wouldn't surprise me one bit, right? But it doesn't have to happen. That's the best part.
Doesn't have to happen.
All right. Well, Sean, we're happy to have you back. I hope you got some nice relaxation. I know you're a big hiker and you got to do some pretty cool stuff, but we're happy to have you back.
Hey man, I had a great time. I hiked about 35 miles over the last 4 days. My feet are definitely a little sore, but the rest of me feels great. And it was a great way to clear my head, and I'm back and ready to attack the markets, my friend.
All right, rock and roll, guys. Let us know what you think. Email us info@allstarcharts.com with any questions you have, and we'll see you right here next week.